Good morning, Trinidad and Tobago. Happy New Year and welcome to the Bourse Report. Well, as is customary, today, at the first edition of the Bourse Report of the new year, we're going to take a look at or review of equity markets, both locally and internationally, how they would have fared, what investors may have enjoyed or endured, and what investors briefly could expect in the coming months ahead, which we'll get into in the subsequent Bourse Report edition. So let's take a look at how markets would have performed firstly during the course of 2022. And at the local level, well, it wasn't a very good year for equity investors overall after a very robust performance in 2021, where the Trinidad and Tobago Composite Index in that blue column would have advanced 13.2%. It did suffer an 11% decline over the course of 2022. Now, that was precipitated in the main by somewhat of a capitulation of cross-listed stocks on the Trinidad and Tobago Composite. Now, those are stocks that would naturally be domiciled or headquartered elsewhere, but cross-listed on the Trinidad and Tobago Stock Exchange, and those stocks would have declined just about 30% over the course of 2022 in comparison to the All Trinidad and Tobago Index, which comprises our local boys born and bred. That particular sub-index would have declined just about 3.7%, so a relatively good performance or not as bad performance compared to the rest of the region as well as the rest of the world, in fact. But overall, the Trinidad and Tobago Composite Index did decline that 11%. Some of the major movers on that Trinidad and Tobago Composite included, on the positive side, firstly, Agostini Limited, which advanced just about 54% on the heels of improving margins, revenue growth, and of course, very positively received acquisition activity across most of its major sectors of concentration or business segments of concentration. And of course, investors would have been rewarding Agostini Limited positively for that in terms of its price increase of the stock. Angostura Holdings Limited also advanced just about 33.3% over the course of 2022, driven by a recovery in earnings and improving prospects, particularly coming into the seasonally strong fourth and first quarters. LJ Williams, be a much smaller segment or a much smaller member of the Trinidad and Tobago Composite, advanced just about 28%, followed by Scotiabank Trinidad and Tobago up 14%, and NGL or TTNGL up 11%, which is rather surprising given the very robust energy environment which we have just emerged from and continue to exist in as we head into 2023. On the opposite end of the scale, some of those cross-listed names come to mind. NCBFG, for example, one of the largest regional conglomerates and a significant weighting on the Trinidad and Tobago Composite Index, declined 43%, followed by Grace Kennedy Limited or Grace Kennedy Corporation, which was down 26%. Whitco, which was continues to have revenue and profitability challenges, down 26% as well, followed by One Caribbean Media, down 25%, and NFM down 23%. Now, turning to U.S. markets, which is the most actively followed international market, of course, and it was pretty much in bear market territory with the S&P 500 index down just about 19%. The bear market definition is a 20% decline. However, that's pretty much about there. Now, all of the sectors in on the S&P 500 would have been in the red, spanning from a modest decline in utilities of 1.5% down to 38% for communication services, with the exception of the energy sector, which was up a whopping 57%. Because of robust energy market price recoveries or robust energy markets prices overall, and that would have all stemmed from the severe market dislocation of energy commodity prices from that Russia-Ukraine war and its lingering and spin-off effects across the global energy markets. Now, turning to regional markets, of course, we spoke about the US in that yellow segment there. European markets in US dollar terms also declined just about 10% in 2022. Asia, a more pronounced 19%, and Latin America, which would have benefited to some extent from rising energy and other commodity prices, would have been offset by growing political tensions within the region. It was pretty much flat for the 2022 period. Now, 2022 was marked by several equity market drivers, and these could very well spill over into 2023. At the local front, we're talking about economic recovery, and of course, that would have been driven in large part by a significant energy revenue windfall over the course of fiscal 2022. Whether or not that spills into 2023 remains to be seen. However, energy prices still remain relatively robust as we head into the new year. Of course, that energy sector recovery, it was predominantly premised on price recovery, but we were expecting to see some modest production recovery, certainly on the natural gas production side as we head into 2023. And this could be offset by inflationary pressures with still elevated inflation, as well as weaker consumer demand, which would be one of the spin-off effects from those inflationary pressures with smaller or lower consumer disposable income in the year ahead. At the international level, well, some of those trends carry over. Elevated inflation, of course, while starting to moderate to some degree, it is still well above historical or target levels for most policymakers, and that will lead to continuously rising interest rates, although we expect some moderation as we go further and further into 2023. Supply chain constraints remain one major factor, which is driving inflation or prices up at the global level. However, this particular factor is starting to moderate to some extent, and of course, geopolitical tensions, particularly that Russia-Ukraine war, and the spin-off impact at the global level will continue to linger without any resolution to that particular issue. So how do equity investors position their portfolios? Well, if you're on the lower risk side, uncertainty is still going to be very much the flavor of the day as we head into 2023. So it might be perhaps better to stay in cash or net cash using instruments such as income funds or repurchase agreements. If you are a moderately risky investor and you have a little bit more risk tolerance, of course, taking a very diversified approach to equity exposure might be better suited to you. And you can look at a host of any locally available equity mutual funds offered by a multitude of financial institutions such as Bourse, as well as exchange-traded funds, which are very highly liquid. And you can also take a very selective stock approach, looking for those stocks which offer a pretty good value relative to historical terms. And for the higher risk investor, well, coming off a year in which markets would have receded so significantly in the US, in particular, almost 20%, and in Trinidad and Tobago down about 13%, this could be considered a buying opportunity for investors with a longer-term horizon and, of course, a higher tolerance for risk, being able to tolerate periods of elevated volatility as we head into the new year. Well, that's it for this week's edition. For more information, you can give us a call at 226-8773, email us at invest@boursefinancial.com, and you can check out our website where all of our research is absolutely free at bourseinvestment.com. That's it for this week. We hope you have a very productive and satisfying week ahead, and we'll see you next time on the Bourse Report.